It's time to give one's head a shake.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, this community keeps growing thanks to you, the Live from the Vault community. And there's a lot to talk about during these historic times. And fear not, because we have the one and only and your favorite Andrew Maguire is in the house. We'll be talking gold in just a minute here. This is going to be an amazing episode, so fasten your seatbelts. You know, the Live from the Vault gives you access to information, gives you access to updates that you just can't get anywhere else, and this episode is no exception. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey Andrew, to answer some of the subscriber questions following the recent volatility that we've been seeing out there, can we start off by looking at where we are in the unfolding of this casino paper to the actual physical battle?
Yeah, Shane, look, this is always a great place to start, my friend. Our objective, though, people need to remember, our objective here is really to expose the various precious metals market players' footprints so that we can make better informed decisions going forward. I mean, that's really what we're trying to do here. So with that all in mind, and looking at all the volatility we've seen since Friday, actually, since last Friday, let's start by assessing where the cross is related to gold, meaning where the paper to physical battle is aggregating, following the commencement of last week's directional, and it was directional, algo-driven paper sell reactions, which is reactions to the new big news reports, the JOLTS report, the CPI, Fed minutes, wrapped up with multiple coordinated hawkish Fed speakers, all out, including this week, ahead of the blackout period that is coming at the weekend. So obviously there's a scramble for these guys to all say their piece. But, you know, these things are not disconnected. Of course they're connected. The Fed has been trying to suppress the gold price, and we're going to go through all those footprints, why they matter, where they actually run out. So it's no coincidence that there are large multi-billion-dollar options bets made against gold expiring above 2,000 next Tuesday. This is what this volatility is about. Nothing else. I will explain how the Fed is actually extremely wrong-footed against this physically driven price rise that we've been witnessing, and how they've used these synthetic cross flows as the excuse to ignite what we call the non-sticky speculator, paper market speculators, and to kind of trigger them to take profits because they've been obviously jumping on board into a momentum-driven price rise, which, just so you know, is an attempt for the officials to rinse out as much speculator-held paper gold as they can dislodge so that they can buy time to unwind what they can of an extremely wrong-footed, embedded, sanction-related paper gold shorts. And these gold shorts were put on up to 12 months ago. Now we'll look at why the Fed's bandwidth to intervene in the Basel III NSFR compliant deliverable gold has been limited to rinsing out as many paper market speculators as possible into an ever dwindling supply of physical gold, which they leverage their paper gold bets on, which, against all their efforts to push back against the rising gold price, has run headlong into unfactored, competing global central bank buying, which they really did not expect. Now, before gold was revalued by the Bank of International Settlements as a physically deliverable first-tier asset at the commencement of 2023 trading, officials could just add as much synthetic supply as necessary to continue to contain gold's revaluation process. And the revaluation process was underway, but being extremely contained. Now, if you recall from last year's a year ago, just over a year ago, last year's March, April, and then the following Live from the Vault episodes, directly after the NATO war against Russia began, an extremely ill-conceived wall of naked short paper gold supply was sluiced into the market by the Fed. We talked about it at the time live, and this was sluiced into an undeliverable gold futures markets, counterintuitively suppressing the gold price into natural safe haven conditions. Obviously, when you've got a war situation popping up, uncertainty, what's the natural thing to do? Run into safe havens. Gold is the ultimate safe haven. Now, so obviously it was extremely counterintuitive to see a sell-off. And this was a coordinated official effort to push back against Russia, who'd opened up an unconditional bid, if you remember, for physical gold benchmarked to a significantly higher ruble price for gold that was being fixed in London at the dollar-related paper-diluted global benchmark price fixes. So, obviously, and then because it's a foreign exchange cross, then obviously that is convertible. Now, we drilled into the minutiae of this event in those prior episodes and how this evolved into Russia offering to sell its oil then at a 30% discount to the market. Now, only if paid for in gold or rubles. What a pushback. And this strategy blew a hole in the sanction packages, lifting the ruble from the rubble that Biden had labeled it to the strongest FX currency bar none. Stronger than any of the other currencies. Why? Because it illustrates how when you begin to back a fiat foreign exchange currency with gold and other hard commodities, it becomes fungible. It no longer fits the profile of a fiat currency, which by definition is just backed by faith. Now, I honestly suggest go back and review at least those episodes, which connect through to how these gold commodity-backed currencies are increasingly undermining the dollar as a unipolar reserve currency. So long story short, Shane, due to gold's 5,000-year uninterrupted fungibility, this higher physical gold price began to rob the paper-diluted Western markets of the physical gold underpinning these leveraged bets. That's a problem. And with this physical bullion flowing into Russia and its allies on a one-way journey, who are actively capitalizing on a risk-free arbitrable gap between the lower LBMA CME paper settled spot gold price and a central bank buyer offering to buy unlimited amounts of this physical gold at a higher physically determined price. Go figure. And this event really marked the very first of many ongoing breaches of the previously contained LBMA CME ring fence that we've been talking about. And another blowback against these very badly structured, I mean, we talked about the ill thought throughness of these. It's mind blowing, actually, as to how ill thought through these sanctions were. These badly structured US sanctions, the blowback was that the commodities and oil, when paid for in gold, was actually offered at a huge discount to the global price. Now, this upset long-standing bets against gold rising above centrally managed ranges, which is the point I'm trying to make here. These ranges were managed. And the attempt to fight this race into physical gold with paper gold sales simply backfired. And the attempt to exit an overhang of potential physical delivery obligations is just not going well for the Fed. And our job is to assess how much traction they can likely get to cover against the strong physical markets before they're forced to fold. And the fly in the Fed's ointment is the very strong, relentless, competing central bank sovereign appearances at every single PM fix, exposing officials to net stable funding ratio compliant physical delivery calls on their paper bets against gold, which they're ill-placed to deliver on.
Wow. Now, Andrew, can you link exactly what you're saying here to what you've been drawing our attention to most recently, and that is the demise of the U.S. hegemony?
Absolutely, and yeah, we'll look at how this forced a change in behaviour, and that's being imposed on the Fed leveraged paper gold suppression bets, and how this conflicts with the competing unleveraged physical buyers. What it's doing is exposing the Fed's desperate efforts to try and defend US dollar hegemony, as you say. Now, in this case, what we're talking about as valued against gold. So obviously that's our focus. And obviously much broader than that. And the awareness that this really boxed in position they put themselves is leaving the Fed increasingly alone in trying to fend off an inevitable gold price revaluation against the dollar. So in other words, how many more dollars it will take to buy back a gram, an ounce, kilo, or a ton of physical gold as they try to cover these paper positions, which are going to be siphoned off. Now, while agent banks who are privileged to have gold accounts with the Bank of England are greatly profiting from the Fed's mandate of trying to slow down the conversion of paper gold to physical gold, these same agent banks, insiders, exposed to the global physical markets, they're long and strong physical gold and silver for their own books. We've talked about this multiple times. And while at the same time, of course, they're greatly profiting from the telegraphed bouts of deliberately injected counterintuitive volatility that they are asked to generate and sanctioned to generate. Now, for their own part, the Fed, trying to unwind remaining extremely ill thought through gold suppression attempts, these extremely wrong-footed officials have tried everything to try and claw back these backfiring bets. We've seen another example of it today. Walls of paper supply. And when that initially ran out in December of 2022, if you remember, that's when they initially kicked in. That's a massive wall of paper supply into what should be a rising gold price. In desperation, they then borrowed physical bullion warrants from the Bank of International Settlements, all of which are now backfiring due to the freshly introduced Basel III NSFR requirements kicking into play at the commencement of 2023. Now, there's very little doubt the Fed had banked on covering this wall of naked short bets ahead of being forced to be compliant. And making the mistake of then doubling down on these paper bets just as the BIS covered all 500 tons of their 2022 paper gold liabilities to zero last November. This is when the Fed was caught out. There is a time to hold and there's a time to fold. And that is exactly what the BIS did, but the Fed did not, because they couldn't. And as we said at the time, Basel III turning gold into a first-tier asset changed the game, pretty much leaving the Fed on their own. It's important to understand this because it used to be just one big central bank attack on gold. BIS want a higher price. They need a higher price. They're in sync with what's going on globally. So the Fed is still holding the bulk of this increasingly impossible to deliver bearish bets against gold. And as we evidence by the obvious agent bank footprints, which are easier to discern, there's a scramble for the Fed to cover these undeliverable bets following gold being made a first-tier asset in January, because all of a sudden this generated synthetic supply was able to be EFP'd. And if you remember, an EFP is simply a mechanism where an undeliverable contract in the futures contract, which is usually settled for cash, can be sent into the compliant NSFR compliant spot gold contracts in Loco London. So what we're talking about is casino chips, the paper gold warrants, casino chips turning into physical. This is alchemy at its best. Now, when landing Loco London, these Basel III compliant contracts were forced to be converted into T+2, which means you have 2 days to deliver under the NSFR regulations. You've got 2 days to deliver this spot position that's just been parachuted into London into deliverable bullion. So the liquidity providers, whereas they didn't used to have the physical, has to have the physical. So this is a far less costly way of securing bullion than driving up and backing a truck up to the Comex back door. And a lot of people forget that. This is really where it all happens. And the footprints are all there. If one drills down and weighs a dwindling amount of paper supply against the rising competing central bank and sovereign physical support levels, the Fed weak flank is exposed to these very savvy competing central bank sovereign buyers. They're extremely keen to swap their depreciating dollars for physical gold at any price. So these takedown events are just making it even worse for the Fed. And the current official takedown efforts are clearly mandated to chart paint gold under $2,000. This is a huge bet against it, not just in the futures market, but in the spot markets. And this is the 10 times larger spot market. So what they're trying to do is target margin calls in the futures market and ignite a wall of paper market selling into which they can cover naked short exposure. But this is increasingly reliant on the extent of how many non-sticky speculators that can be rinsed out. That's the equation.
Wow, this is fascinating, Andrew. Now, we've had a lot of questions over the last couple of weeks as to, where the central bank sovereign physical support levels are stair-stepping higher to. Can you bring us up to date on these levels, please?
Yeah, and this is really what this is about, so we can make better informed decisions. We just need to drill down a little for this. The focus is on how the extremely wrong-footed options data, the derivative data around gold, which reflects bets made from the various CTAs, the commercials, the official market participants from up to 12 months ago. These are often placed well over 12 months ago, following the Russian sanctions being instigated. Now, cutting to the quick, it's now the blinkered speculators who are the most wrong-footed, while officials are also offside, but they're able to print dollars to buy back shorts that cannot be offset, at a higher price. But conversely, an increasing volume of sticky long speculators are holding on for the long haul. Now, in many cases, go figure, they're using the futures market for what it was intended, legitimately hedging other risk positions or indeed physical positions on the Comex, so that the bandwidth to use paper supply against the speculators really is essentially greatly reduced because these guys are using it for legitimate reasons. They cannot be rinsed. This is evident in the induced levels of chips floating around the Comex casino. In other words, what is reported as levels of open interest. And obviously, this is a simple game. This is a casino. You could really just draw the comparison to what happens in a casino. And as we reported last episode, and as we're still assessing, net of rinsable speculators, the inflection point is where the largest aggregations of central bank sovereign stair-step support lines cross against the cartel. Now, this is what our job. And this looks to have risen well over $130 higher than the March levels, and aggregating at around $1,950. That's $130 higher than a month ago. And that was a guarantee bounce. And however, the sheer volume of this T+2 demand being accelerated by we reported the global de-dollarization efforts that are going on in concurrently with this, it possibly raises this floor closer to 2,000 after Tuesday. Tuesday is when these options derivative positions expire, which leaves very little low-risk short-covering wriggle room for the cartel. Now, while the recent banking crisis has added fresh, additional bullish for gold safe haven drivers to really hard test these paper market capping bets made against gold, and of course related silver, Shane, as you know, this is in fact, it is in fact Basel III compliant gold NSFR compliance, which really officially kicked into play at the open of trading this year, that is the major bullish for gold driver. That is going to really force discipline on the same actors in the silver markets. Now, banking crisis aside for a second, it's still not appreciated by most CTA and general speculators, especially those who have historically been rewarded by coattailing and complying with the house set painted cap ranges. In other words, here's the range, we'll do it enough times and it becomes learned behavior. And so the paper market game that they rely on being contained by the house is changing. And so in other words, just like the odds. And they are increasingly being hung out to dry on their paper gold and silver capping bets. So really, it's important, obviously, just so I'm not just using the word options. I mean, options are simple. They try and make it a very complicated subject, but options are simply a derivative bet where you pick a strike level such as 1800, 1900, 2000, whatever it might be, usually months ahead, could be months ahead, and you set a price which you can keep. You can keep this price. You actually sell it, and if you're betting against a price, you keep it. It goes into your account, and you can keep it. If the options expiry mark to market price at expiry is at or below that level. Now, options traders are the first to be carried out feet first, because it is unlimited risk when you do that. So if it rises above these levels that you have bet against, you're exposed to potentially unlimited losses, far more than you ever bet. Conversely, you can do the same if you're betting against lower prices, and that is what the game has been contained to, learned behavior, a range, and then you just look ahead and say, well, it'll be contained, so I'll make these very risky bets. Oh, they've worked for a while. They work until they don't. Now, drilling down, this structural change that we're talking about is partly revealed in the Comex LBMA option structures, where right on cue, and just as would be expected, T+2 spot gold NSFR delivery compliance and competing central bank and sovereign physical demand has forced a major structural change in who is betting against gold, breaking above its cartel-imposed paper-driven 1700 to 2000 range, which is what they have been betting for some time. And we have over 50 years of Comex paper market dilution has really largely ensured that very large cartel bets made against gold rising or falling outside of this predetermined range into monthly multi-billion-dollar mark-to-market options bets would inevitably be settled inside these predetermined sweet spots at expiration. And this is why, regardless of the technical, real physical market, supply-demand fundamentals, gold and related silver would 9 times out of 10, if not 9.9 times out of 10, be relied upon by magic to return almost to the tick, to these exact multi-billion-dollar sweet spots at options mark-to-market events. Historically, this deliberately injected disruptive synthetic volatility evolved into learned behavior, sucking in other market participants who would dutifully and in all innocence protect their long and short positions with stops. And this is exactly what we're seeing now. But don't let it faze you. In fact, if you're a stacker, you are loving this. And given the spec long or short positions are borrowed from the house, unbelievable, but yes, from the same bankers who are betting against you, you borrow it from the house. These lenders, the house, knows exactly at what price these positions would become untenable for the borrower to maintain. And that if you're big enough, you've got a big enough position, you wonder why in the middle of the night it's got taken out and suddenly the price moved back or even back up above that level. And now, given the house has already predetermined this mark-to-market sweet spots, Any speculator betting outside these ranges were historically hunted out and rinsed. Furthermore, regardless of the degree of safe haven gold demand, whether driven by geopolitical, structural, economic reasons, by having access to unlimited quantities of undeliverable, freshly printed paper market supply, monthly counterintuitive selling events were instigated and, to maximize the effect, usually ignited at, of course, the thinnest and most illiquid times of day. The unnatural, unfathomable injected volatility by design also spooked fresh investors from ever investing in safe haven gold as an asset class, and until this year, keeping the game ring-fenced really into a known set of players. However, for reasons that I will explain, the house positioning has changed to be far more in sync with the competing central bank and sovereign physical demand, as it is forcing this EFP delivery obligations upon them in increasing size. This is a huge drain of chips out of the casino. And this is now the non-sticky speculators almost exclusively holding the naked shorts. So it's these rinsable ones, guys, that are holding the naked shorts against the house. And for their part, officials can print fresh dollars and buy back gold shorts at a higher price, albeit raising the price when competing with central banks, competing foreign central banks. So it's really more about price is far less the issue here. It's the dwindling lack of Basel III compliant bullion.
You know, Andrew, talking about Basel III, I believe it was well over 2 years ago that you identified that when Basel III NSFR compliance turned physical gold into a tier 1 asset, that would force the long-awaited gold price reset. Can you maybe give us an update on where we are on that line now?
Yeah, absolutely. And up until then, Basel III NSFR compliance was imposed on the gold cartel on the 2nd of January of this year, the officially sanctioned cartel market-making agent banks privileged to have gold accounts with the Bank of England were able to add unlimited quantities of undeliverable paper gold in sufficient size so as to be able to manage the unstoppable but very slow stair-step price rise in the price of dollar denominated gold. They could never stop it rising, but they could contain it enormously. And the agent cartel insiders are able to make, at the same time, vast risk-free possible profits because they're insiders, they know what's coming, by aligning their predetermined bets with officials, symbiotically really rewarding the specs that are coattailing them. And it's important to understand that we're witnessing the culmination now of a 50-year gold price suppression scheme. And we are actually privileged to make history, all of us now, and we're about to see a real physical gold price emerge from these ashes. And it's important to remember, it's not that gold is actually going up in value at all. It's just that it will cost many more printed dollars, pounds, euros, yen, whatever, to buy the same ounce of gold or silver. First and foremost, our focus really is primarily about wealth protection into an increasingly inflationary environment. And as we've been warning, this will touch everybody, even those not in the markets. So right under our noses, as we've been discussing in all our 2023 episodes, the very same accelerated de-dollarizing process that's being driven by competing central banks swapping literally billions of depreciating dollars to buy physical gold is also driving the dollar price of gold higher. Why is the question I often get. Because this physical gold is really just serving a 5,000-year-old purpose. This time becoming a major component of what will back the rapidly evolving gold commodity-backed BRICS plus currencies. And this means, and this is important, that commodities will increasingly be priced upon a significantly higher dollar-denominated gold price. And this will have the massive inflationary implications for commodities priced and bought, continue to be priced and bought, denominated in fast depreciating Western fiat currencies. So many people don't get this. And while considering this gold-backed currency will ultimately be fit for purpose to provide adequate liquidity to accommodate the lion's share of the 7,500 billion per annum. These are big numbers. Global oil and gas markets. We also got a 5,000 billion per annum commodity and energy sectors. It's fit for purpose to look at to actually be liquid enough to power the adoption of this, and the scale of this potential gold adoption becomes much clearer when we look at the size of this condition and the speed that this is going to roll out. So really, gold benchmark in dollars will have to revalue at multiples of today's paper diluted cap price. And for those that are still blinkered to the belief that the gold market is housed in the Comex casino and that it's safe to short gold inside the house ranges that we've been talking about, it's time to give one's head a shake.
Now, Andrew, talking about the Comex casino that you just mentioned, I recall that you were looking at all the reasons specifically why the Comex was formed some 50 some odd years ago. It would be worth maybe outlining these reasons for our new subscribers or people that are just joining us here.
Yeah, Shane, happy to sum that up really quickly. Following Nixon depegging the dollar from physical gold in August 1971, a plan was hatched to integrate gold into the Comex Futures Exchange. The sole purpose was to dilute physical supply with paper gold in an attempt to really halt the avalanche of foreign governments redeeming dollars for dwindling physical gold reserves. However, in 1971, with gold still priced at $38 an ounce in the foreign exchange markets, the dollar conversion price continued unabated. It just carried on. People smelt the game. Despite the gold price being revalued higher to $42 in 1974, they couldn't halt this race from the central banks. They just continued to redeem their dollars. So something had to be scrambled together to halt the drain of US gold reserves. So on the 31st of December 1974, gold was integrated into the 1933 formed Comex futures markets. And the primary purpose of adding the gold contract, into the Comex futures market was to inject sufficient official synthetic undeliverable gold supply and price volatility that would be necessary to control the price of foreign exchange gold. In other words, by completely obfuscating supply-demand fundamentals, the Fed was able to convert a real deliverable physical gold bar into a highly leveraged, unbacked, paper-settled fiat gold currency. That's what they did. They turned it into a fiat currency. And while the Fed denies intervening in the gold markets, they openly admit actively cooperating with other central banks on a regular basis to intervene in the foreign exchange markets, of which gold and silver is one, as may be necessary. So with sleight of hand and unlimited ability to print dollars, by converting the physical gold market into just one more unbacked fiat currency, for the ensuing 50 years, until we saw Basel III kicking in, they were able to surreptitiously manage the gold price. However, on the first trading day of 2023, Basel III NSFR compliance made spot gold T+2 deliverable. You're a liquidity provider playing that game, you better have that physical in your vault. And the ability to utilize the Comex EFP conduit to siphon off previously undeliverable cash-settled Comex gold into the compliant NSFR spot market has constrained officials' ability to continue to generate unlimited quantities of synthetic gold. This is a huge change in behavior. They're now limited to what can be squared off against speculators contained inside the casino walls. And look, drawing back for a second from the short-term charts, the pieces of the jigsaw are all there. And if you recall, and you'll remember as a subscriber, you will recall how we dealt with this issue a few times now. Back in 2013, just as the first cracks appeared in the LBMA markets. Now, if you recall, the ABN AMRO refusing physical gold and silver bullion coins and bar delivery to their clients, sent out a letter, and our clients came, we were first to get this letter, and our clients said, hang on a minute, they're refusing us delivery of our bullion. So just remember, that was the backdrop. US traders, including the licensed CTAs, were suddenly forbidden from any longer trading the 10 times larger global spot foreign exchange markets. And it forced their trades to be siloed inside the US-centric Comex ring fence. As a US trader, you will know that you are forced to trade gold and silver in the futures market. You cannot come into the global markets, deliverable markets, and trade. I know that because we had to get rid of all our US clients. And yet concurrently, the market-making Comex actors, this is the key, they were still sanctioned to make markets in both the Comex and the spot markets. Now, these US traders' restrictions even extended to complying with freshly introduced 5-minute CME-instigated Comex market halts when you've got a volatile situation, usually on a price rise, and 3-minute options market halts, while at the same time the house actors were still able to freely trade the 10 times larger spot delivery markets to the exclusion of traders siloed in the rigged casino. Good God. I mean, no one questions this paper-centric rescue attempt. It is just blatant market rigging and an attempt really to maintain this 50-year-long price suppression scheme. And what has changed, but is actually partly witnessed now into the current rigged official Comex generated sell-off, is that as we entered 2023 trading, wrong-footed speculators are now holding the bulk of these naked short bag, while the insiders take the long side against them. And their footprints are quite clear, especially when you weigh them up against what they're doing. And when you look at the COT report and you see the swap dealers bring up short positions, this is largely hedging physical exposure. They're not going to be exposed to physical exposure, but what they're doing is rinsing out what they can of what is rinsable. And as we've been tracking, and it's really important to factor into one's decision-making process, when the cartel tries to shake out gold investors, the insiders are limited to how many naked long or short specs can be rinsed out, but constrained by where the lines cross against their physical exposure being uncovered, which is exactly what we're trying to expose for you here. And drilling into the weeds, we note multiple examples of historical cell trigger inputs that failed to get sufficient cell ignition to cause any meaningful chart damage. This structural change in behavior is being forced into very strong physical demand. And as we always expect volatility around round numbers. I mean, once, say, for example, 2000, once 2000 is confirmed as the next stair step, it will begin to get front run. And we already see the option sweet spot for next month, not this month, not the expiring month here, aggregating higher, closer to 2050. If this settles in as the next central bank supported stair step, watch out above. In summary, really, when we look at these developing supports into what is still rinsable, it looks like 1950 gold is aggregating sufficient bids to overcome paper sell orders. That's what we're seeing. And this is what our liquidity providers are reporting. This is where the big bids are. And there's no physical gold sell orders at all, though, into this options-related sell-off. So remember that. It's nothing to do with physical at all. And for silver, dips below $25 continue to ignite very strong Asian physical buying into a very tight for supply physical market. And so for you traders, options open interest for May, which is the contract that's just about to expire next Tuesday, that the number of chips involved in that is anemic, with the sweet spot for SI really just under, for silver futures, just under $25, suggesting this current April gap close sell-off really into this lower range that we've just seen today is an overshoot. It looks like a hell of an overshoot and a hell of an opportunity. And as we highlighted in our last two Live from the Vault episodes, while the mainstream media and officials try to spin that the banking contagion has settled, our well-connected first-tier liquidity advisor report that lower down the food chain, the commercial real estate market, the CRE market, is poised to implode. This is not yet factored into the risk markets. And given that 70 to 80% of all CRE lending is being conducted by the smaller regional banks into now extremely tightening credit conditions, officials are trying to draw attention away from this very real contagion risk. However, this is precisely what is making a larger proportion of the usually rinsable CTA specs sicky, and it will limit official efforts to rinse them out. So they're doing it for the correct reason. And into the toxic for risk mix, a wrong-footed Fed battling inflation are hobbled by the fact that it was the aggressive pace of their whack-a-mole recent race hikes that it was responsible for triggering the recent banking crisis in the first place. And having burned credibility with everybody, the wrong-footed Fed is now caught between a rock and a hard place. They're forced to either tail off race hikes, or when the commercial real estate shoe finally does drop, and it could happen any day, and it will, they will be forced to start cutting rates to avert triggering a far worse bank run, which is currently being driven by interest rate differentials between regional banks and the higher rate ballooning money market funds. So that's where the flow of funds is going. And while many investors seem to miss, what they do miss is that these money market funds are not safe. They can be gated, meaning waking up to you being unable to withdraw. You go to your phone and you think, I can just withdraw that money. Oh, I don't need to queue up anymore. I can just do it on my smartphone. Oh, you suddenly find your funds are frozen and that you cannot withdraw them. Why? Because there's a potential for these funds to be bailed in. This happened around the time of Lehman. They say there's no comparison to Lehman. This is a potential risk. And anyone that's not hedging their assets at this point with gold are really, you really need to give your head a shake. You know, when we hear of asset managers moving into cash, so you think, oh yeah, cash. It's not cash. They're just really, you're just making an unsecured loan to the banks receiving these funds, which can be swapped for shares in the bank. You just wake up, no, you haven't lost money. Oh, by the way, you've got X amount of shares and here's your remaining cash. Oh yeah, and you never even saw the balance sheet of that bank. This so-called safe haven cash move is in fact just one more high-risk trading decision. So what's left to say? All of this leads to just one question, guys. How much physical do you own?
Hey, Andrew, thanks so much for talking gold. I mean, what you just said about those bank shares, we have our notary, a notary in Italy. It didn't happen to him once. It happened to him twice, exactly what you just said. Maybe on another episode we can talk about that. But remember, to our Live from the Vault community, buy physical and make sure it's one-to-one physical, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Information that you just can't get anywhere else here. And this episode is a classic example of that. So please help spread the word about this channel by hitting that like button, not now, but right now, and sharing it with people that you know, and hit the subscribe button. And if you click on that bell right there, you'll be notified in real time as each episode gets posted live. So with that, we'll see you next time right here on Live from the Vault. See you then.